Hi everyone, my name is Kenneth, and today I want to present you my research titled Retail Investor Attention Impact on Indonesia Stock Market Return. Our research was conducted by Kenneth and Zafri Arantohusodo PhD, and we both are from Fakultas Ekonomi Bisnis Universitas Indonesia. So first of all, we know that in finance theory, information will affect asset prices. One of the most famous theory about information is efficient market hypothesis, which stated that price of financial assets will immediately reflect all available information. This hypothesis is based on Homo economicus assumption, where humans are described as perfectly rational, maximize self-interest, and have perfect access to information and can absorb all information. However, in the real world, humans are more limited. We have limited capacity and limited resource, and also we cannot absorb all information because information will consume our attention. Previous studies, Scroff et al., stated that information will not be fully reflected into asset prices if no investor pay attention to it. So, the investor attention is the bridge for information to incorporate it in asset prices. So, our studies, we want to measure retail investor attention impact on stock returns. We conducted the studies in Indonesia stock market and during the post-crisis period from April 2020 to February 2021. We also test the delay or the lags because previous studies suggest that information will not immediately incorporated into asset prices, and Ta et al. Found that it took 2 weeks for information to impact positively to stock returns. Another previous studies, Bijel et al. Also explore various lags from 1 week to 5 weeks, and they also conducted the studies during post-crisis period. So here how we measure retail investor attention. We use Google Trends, which is provided by Google, the largest search engine in the world and Indonesia. In Indonesia, Google market share is more than 97%. So Google is the largest search engine used in Indonesia. Google Trends shows a relative values ranging from 0 to 100 for the number of search requests from certain region, certain period, and also we can filter from categories, for example, finance categories, and also we can filter from the source. Here, the example is from web search. And for the sample here, we use ACES as our keyword. ACES is the stock ticker for Ace Hardware Indonesia, the largest hardware retailer in Indonesia. We can see here the value, the highest value is 100 because the data is normalized by Google. And here, if the Google Trends is show daily data, and so we can use it and we can compare it to daily stock returns. So previous studies suggest that Google search volume will measure the attention of retail investors. A study conducted by Ta et al. And also Bijel et al. Validate the studies and found the same, that Google search volume measure the attention of retail investors. The reason why is because institutional investors have more sophisticated platforms such as Bloomberg Terminal or Thomson Reuters, and also one searches from institutional investors can move large amount of money and can impact the stock returns more powerful. So the increase of Google search volume are more represented by the retails. And also another researcher, Barber and Odin, said that individual investors are more likely to buy attention-grabbing stocks. And also they said that retail investors are net buyers of stocks that attract attention and price pressure phenomenon will occur. And the last one is by Beagle et al., where they conducted research during and after 2008 market crisis. They found out that Google search volume has a negative relationship with stock returns. Beagle et al. Test various legs from 1 to 5 weeks legs. And for our studies, we conducted in Indonesia stock market. Indonesia stock market have some interesting phenomenon that occur during our research period. First, in March 2020, the Indonesia capital market experienced a crash with a price decrease by 32% in a span of 1 month. And from April, the Indonesia stock market start to recover from its crash. Also, Indonesia stock market in 2020 achieved many records, such as Indonesia stock market achieved its highest number of capital market investors in history. And also, we have the highest domestic ownership in history. And in 2020, the domestic investors is more than the international investors. And also, last, the increase in individual investors in 2020 is increased very significant by 95% increase compared to 2019. So this is the highest growth and also contributed by the young investor aged 18 to 30. Our studies sampled data from LQ45 index, which this index is one of the main index that its purpose is to measure and to represent the whole Indonesia stock market. And LQ45 is rebalanced every twice a year, and because the rebalancing, we got more stocks. In total, is 57 stocks as our sample. Actually, we have 58 stocks, but we remove one stocks with the ticker BKSL. BKSL stock price is not moving for the most of our research period. The reasons why is because Indonesia Stock Exchange have a price floor regulation where a stock cannot move below 50 rupiah per share. And BKSL in most of our research period are stayed in the price floor 50 rupiah. And we source our data from first Bloomberg Terminal and also Thomson Reuters. We choose these two data source because of the convenient to gather the data. And these two data source is both registered as the official data distributors from Indonesia Stock Exchange. So the data should be the same. And for the investor attention, we gathered the data from trends.google.com. We conducted the research for 2019 trading days using daily frequency and from April 2020 to February 2021. Here is our models. Our models inspired by previous researcher Vigil et al., who conducted the research during and post-market crisis. We used 5 independent variables. The first one is lag excess return. And the second one is lag standardized Google search volume. And the third one is the lag volume. The fourth one is short volatility. And the fifth one is long volatility. We only measure the excess return. So the return is adjusted by dividend. And we measure the Google search volume. And then we standardize the data, similar to the approach used by Vigil et al., the previous researcher. And for volatility, we use Parkinson volatility to measure the short volatility. And then for long volatility, it is the average for a weak volatility that we get the data from the short volatility. So we adapt Vigil et al. Research, and because they use 5 different lags in their models, we also test 5 lags, which is lag 5, lag 10, lag 15, lag 20, and lag 25 for the lag return, lag SGSV, and lag volume variables. And our test indicate that a presence of heteroscedasticity and autocorrelation, and therefore we used robust standard error to estimate our standard error, and moreover our p-value using HAC New West estimator in our data panel regression. This is our results of panel regression using robust standard error HAC New West estimator. And here the results are consist of 5 regression results for the lag 5, lag 10, lag 15, lag 20, and lag 25. And here dash correspond to not significant, 1 asterisk correspond to 5% significant level, 2 asterisks to 1% significant levels, and 3 asterisks mean 0.1% significance levels. So here is the findings of our research. First of all, we have small R squared, a very small one, but this is expected because previous studies, Vigil et al., also have similar R squared below 0.02. The small R squared is not a problem because our main research is to know the impact of Google search volume to stock returns. Our findings, the first findings is lag volume are consistently have significant and positive relationship with the excess returns. These significant and positive relationship are consistent on every legs, and therefore we know that an increase in trading volume can predict a price increase in a few weeks. And on excess return variable, we found that lag excess return also consistently have a significant negative coefficient. And that means It indicates a stock return tends to revert to its mean. So an increase in previous excess return predict a decrease in today excess return. And on SGSV variable only significant on the conventional level for leg 10, leg 15, and leg 25. On these three legs, it have consistently have a negative impact on excess return. Therefore, an increase in investor attention can predict a negative return in a few days or in a few following weeks. We can conclude that the best model is the leg 15. Leg 15 have the best R squared and also have the best significance for all of the independent variables. On leg 15, one standard deviation increase in leg standardized Google search volume can predict a decrease by minus 0.073% in excess return. So, in other words, if the previous 15 days leg standardized Google search volume increased by one standard deviation, today excess return will decrease by 0.073%. This is a very small impact, and for other variable, the impact are also small. For example, in leg 15 return, one standard deviation increase will impact lower return by minus 0.19%. And the trading volume variable has the most highest impact compared to the others, with an increase in excess return by 0.14% for every standard deviation increase in leg volume. And the negative relationship between Google search volume and stock return is consistent with the previous researcher whose models we adopted, Bijel et al. Bijel also found that an increase in Google search volume will followed by negative stock returns. So this is the end of my presentation. Thank you very much for your attention.